Okay, so back in the day, there was a guy called Ram Emanuel who coined the phrase, don't ever let a good crisis go to waste. And I think this is the perfect opportunity to talk about that. Now, yesterday, the yield curve finally inverted for the first time since 2019. And the yield curve inversion is a very accurate predictor of a recession. So if you're headed to a recession, at least it seems like it, how this crisis can be used to make money in the stock market? Well, I'll explain in a second because there are money-making opportunities and plenty of in this new scenario. So don't go anywhere. This is going to be a really cool video. Check this out. What happened yesterday? Why is it that important? And most of all, how can we make money off this? Well, check this out. A few basics first. The US government needs to raise money to fund its operations. And the way they do it is by borrowing money from the public. It issues debt, anywhere from 30 days to 30 years. And you get interest. Now, the longer the instrument, the higher the interest, which is kind of normal because the longer you hold it, the more risk you have. And you're compensated for that risk. So for a 30-year, the interest is going to be higher than for a 30-day. That's how it works. What happens if the yield inverts? If the 2-year actually has a higher yield than the 10-year. How is that even possible? Because the 10-year is much longer, more risk, right? So it should not be in that manner. And this is in fact the first time since 2019 that we had this happen. And most importantly, this is a really good indicator of a recession that's about to hit the United States. But before you go jumping off and selling everything, hang on, give me a few minutes to explain to you why things are not as bad as they look. In fact, we have some massive opportunities here. Check this out. So basically, statistically speaking, every time that the 10-year bond gives us a lower yield than the 2-year bond, which means an inversion, every time since 1955, that meant that a recession hit the United States anywhere from 6 to 24 months since the inversion. So that means that we have at least 6 months or at the most 24 months. Now, if you go back to 1900, which means 120 years ago, you're looking about 22 out of 28 times where this prediction actually worked out. So you had 28 inversions, and out of the 28 inversions, 22 of them were actually recessions. And the time frame was really similar, 6 months to 36 months. So whatever you want to say, the fact that the yield curve of the 2 and the 10 actually inverted gives us a high likelihood of a recession anywhere from 6 to 36 months from now. Now, that's not much of a prediction that we can do anything with, but hold on. If you go back and you look at 2019, this is where the last time this happened, we did get a recession. However, that recession was basically caused because of COVID and the pandemic. So maybe without COVID, without the pandemic, that inversion actually don't pan out. So if you want a positive of why we're not about to hit a recession, that's one. There's others. For example, the shorter yields are not inversed at all. In fact, they're widening. There's a lot of counterclaims to this. But let's assume for a minute that a recession is coming. Is this really bad for us? Does this mean we should sell and stay out of this market? Not necessarily, and I'll explain in a second why. So the first thing you need to understand is that the reason that this is happening is because people are seeing more risk in a 2-year than at a 10-year because of the rate hikes. Everybody's fearful that the Federal Reserve is going to actually increase interest rates to the point where these bonds become pretty much doo-doo. Now, when you raise interest rates, you cause a few things. Number one, you battle inflation. But raising interest rates, it's a little bit of a double-edged sword because as you're battling inflation, you're also killing the economy. It's like taking antibiotics. You're killing the thing that you're supposed to kill, but you're also hurting the body. Because when interest rates are high, people are more inclined to save than to spend, which means less money goes for spending and consumers. And it's not only the retail market and the consumer behavior. The banking system also suffers at higher interest rates. At higher interest rates, the yield curve, as you see right now, goes up for the short term, basically closing the gap between the, let's say, the 30-year and the 10-year. It starts to close up. And as it closes up, the banks have less money to work with because the way the banks work, that's the cheat code, they'll borrow cheap money and they'll lend you out expensive money. And they need that gap. And of course, once the yield flattens and that gap doesn't really exist, the banks, don't really have an incentive to lend out money, which leads to a credit tightening, which leads to less of growth and less of economic progress. Not to mention the fact that cost of capital becomes more expensive. Even if you get a loan, it's more expensive than it was a year ago, which means that you have to make more money and generate more cash flow to get the same amount of profitability, which is not that easy. So the whole market is going into this recessionary spin once you rate hikes. If the market isn't strong enough to handle it, you might actually see a recession, which is exactly the warning we're getting right now from the 2-year and the 10-year inverting. But there are massive money-making opportunities here. Let me explain. Right now, we have 8% inflation in the US. That is the official number. When in reality, we all know that the number is double digits. It's probably around 15%, and I'm just being gentle right now. So you're losing anywhere from 8 to 15% of your money purchasing power every year if you just leave it in the bank. Buying bonds is also not a good option. You're getting what, 2, 3%? I mean, look at inflation. It's not really a winning deal, right? What about real estate? You can put your money in real estate. That's a safe option. Usually, that's kind of the textbook answer of what you want to put your money in inflationary time. But the problem is it's oversaturated. You're going to be buying in a seller's market. It's gone parabolic. I don't like to buy at a parabolic market. It's usually a sign of shit about to go down. Look, the median price of a house that's being sold in the US in the past year and a half, 2 years has skyrocketed. Q2 2020 all the way to Q1 2022 is 28%. So the house prices, the median prices for houses in the US went up by 28%. So you're basically left with the stock market. But here's the kicker. The stock market is recession proof. I know it sounds crazy, but let me show you why. And here's the reason. Since 1980, in the past 40 years, we have 5 recessions. That's a recession every 8 years. So that's plenty of recessions. But if you look at the S&P 500, in those same 40 years since 1980, it did 4,000%. 4,000% in 40 years. So as long as you invest in fundamentally good companies, profitable companies, companies that you're invested in long term, and you're not trying to time the market, you understand that time in the market will beat timing the market every single time. We're talking about 5 recessions in 40 years, 4,000% just by holding on to the S&P 500 by an index. So that's just my advice. Time in the market. As long as you can pick good companies that you want to be invested in long term based on solid fundamentals, you will be fine. And as always, if you want to comment on this video and hang out with me and the Tip Ranks crew, head on over to Tip Ranks TV. We're going to be there commenting on this video, chatting with you, hanging out with you. It's going to be a blast. Come check it out. It's a really cool platform. I absolutely love it. I'll see you there.